So good evening, everyone. This call is regarding SIF. SIF, we all know, this is one of the new product launched in the market under MF. So we all, must have read lot much about SIF, and we have seen, last few months, few offerings also came out from the AMC side. This is again, you can say this is one of the offering which we are presenting in front of you. It's Diviniti Equity Long and Short by ITI Mutual Funds. So why this fund quickly, SIF, I am sure everybody must be understanding here, one can take a long short kind of a position, and there are the different categories. And the minimum investment in this particular product is 10 lakh. Here quickly, I will just, introduce you, Mr. JP Singh. So I am sure we have done lot many calls and webinars with JP earlier also, and give him a quick uh, thing like how about Mr. JP. So he is having around 25 years kind of a experience, and he was earlier with Mahindra Manulife. And I think there we have done a quite a bit interactive session with JP. And he has worked in this industry, since long in a various positions and various organizations. So quickly, why Divinity SIF? We have opted and we have kept this call because under AIF structure, ITI is any which ways running this particular product, and now the same kind of, I think, the entire overall the structure is going to be here in AIF as well. So to know more about this particular product, I would like to hand over this call to Mr. JP. So he can give you a brief about overall product, what it is, and how this product can be fitted in the client's portfolio, and in this volatile market also how this product actually can suit to the clients. So over to you, JP.
Thank you. On the product, I'll surely cover. But since this is one of the first, maybe you had interactions, but was first interactions regarding the product itself, let me give a brief background, and that will cover a lot of things, including how the product is placed, including how this has come into origination and so on. So just to start with, about 3-4 weeks back, I had gone to visit my son who is working in London. And since I was in London, I thought, let me meet one or two of my clients. So they are my investors from London who are invested through Gift City, not in mutual fund, but in AIF. So I met one of the large ones who is Indian, and runs a fund out there who invests in India and happens to be my top 3 or 4 largest investors. So when he saw my visiting card, he saw the word SIF, and he was intrigued and asked me what SIF was and stood for. And I very excitedly tried to explain him that there's something very innovative that SEBI has done. And then when he heard me, in the end, he told me, look, this is nothing new, because this form of funds or specialized funds, as we call, already exists there in Europe. And in one form or the other, long short funds are already known across the world, which we are already aware. And very frankly, if 1-2 years earlier somebody had asked me, I would not have been able to give so much details. But since I've been involved with ITI and in SIF from day one when the regulation came, I worked on the product, we made the product. So, apparently I am very excited that genuinely there's something very different which has come to the retail market. So I'll take you through little more background and about the product, right? So the product goes like this. We in the last maybe 25-30 years back, we started selling mutual funds, and the words like long and all those words did not exist. Mutual fund was mutual fund. What we were doing is we were trying to convert distributors who were selling fixed deposits and post office and insurance. And insurance was LIC only that time, and asking them to learn about mutual funds and telling them how compounding works and SIP works, and how brokerage can be beneficial for them, because you trail brokerage, long-term oriented, and all those things. In the last 15 years, there has been some innovation, and one innovation is this, that PMS came in, which were like once upon a time customized, segregated, non-segregated portfolios, but now we are aware that there is some regulation around that. And some time back, this is not very long, maybe 7, 8 years back, it happened earlier, but more 7, 8 years back it picked up, which is something what we call AIF. So the main difference in, if you ask anybody in the market, people will say, look, mutual funds investment is like 1,000 rupees, 500 rupees, and so on. PMS is 50 lakh rupee, which used to be once upon a time 25 lakh rupee, and AIF is 1 crore rupees. Generally, this is where people stop. But actually, the difference is more. And the difference is key in the structure itself. It so happens that in India, the mutual fund, the PMS, and majority, I'm saying majority of AIFs are all long products. Long basically means if you give me 100 rupees, I buy a security, whether I'm in debt, equity, whatever wherever you give me, I make a portfolio, and I have to make a long portfolio, which means if I buy, I take delivery, I keep it in the portfolios. Barring few select schemes, and to name one or two of them would be balance advantage funds. And I'm talking about true balance advantage funds, right? Type of schemes. Generally, fund manager do not move the portfolio. They will hug the benchmark, then try and be regarding benchmark. You have heard words like, "Look, we don't keep cash. We are invested." And look, tell you, even we are same at ITI mutual fund. The long fund are supposed to do that because there's a benchmark. Every fund manager is expected to be equal or better than benchmark. Every fund manager is supposed to do well compared to the relative performance vis-a-vis competition. So not so so even if the fund manager sometimes have a view, they just trim the portfolio key, some portfolio they will bring down from growth to value based stocks, cut the beta, but they will not be generally in cash. This is what we have seen in practice. And very frankly, this is very practical also, because market move, and you can trail the market in case you are in cash. It's easy to say be in cash, but hindsight bias helps you. Forward looking things, generally, if the market is down, why should be in cash? Normally that plays out. And even if the market is up, you don't know how much it will go up. So being in cash may something in historically may be against you. So there are few people who do it, right? And hats off to them. Even in PMS, it is long. Majority AIFs like credit funds, unlisted PE, VC, real estate, most of them are in long. There's nothing called long short. But sometime back, and I'm sure it's been some time now, there was a category, especially in category 3 AIF, which came up and it's called long short. So recently, in the end of February 2025, there was a regulation which is called SIF regulation, of Specialized Investment Funds regulation, which has approved, a product which is placed somewhere which has a nature both of mutual fund and AIF. I'm using about AIF, not PMS, because it is like AIF, because mutual fund can only be long. Mutual fund cannot short anything. PMS long, most of the AF long. It is only long short products which hardly is any percentage in the total funds we manage. Mutual fund manage 75 lakh crore, PMS and AIF approximately maybe 30, 40 lakh crore more. So we are managing 100, 110 lakh crores. And my guess is anywhere, maybe it would be only 2, 3%. Even that is high, I think. Maybe 1%, 2% of the portfolio is only long short. Now, what does short mean? I remember, I was at home giving a presentation to my team. This is a few weeks back. And when I said, you can short. So there was somebody who was ignorant, maybe a new joinee at my team. So he said, sir, short kya hota hai? How can you short? So I told him it is something you don't own and you use the futures to short. So the question was, sir, if you don't own, how can you short? How can you sell that product? How can you sell a security? Look, it is through futures, naturally. So one, if somebody says long and short will always be through derivatives. There is nothing else that you can do, right? Because it is the question has an answer also. The question was, how can you sell something which you don't own? Which basically means long will always be, you are giving money to manage, and you buy security and hold in your portfolio. That is what is long. Short will be using derivatives because there's nothing else that you can do but use derivatives, that is short the future, or use options to that extent. Now, now just to now while I'm just showing some of the slides, but to tell you some of the features that has come up and has been given by SEBI. I think the regulator did a very excellent job in terms of very deep thinking, in terms of putting forward a very long-term oriented product, because this product, how they placed is this, that they first of all said that this is not a separate license that you need to take. So basically for AIF, you have to take a license, PMS, you have to take a license, mutual fund, you have to take a license, AIF, you don't need a license. Only those people who already have a mutual fund license, I'm repeating, a mutual fund license are eligible to take additional permission to launch SIF. SIF now, or specialized investment funds, are part of mutual fund. Any scheme we launch will be, or most of the qualities of management will be just like another mutual fund scheme, but for some extra flexibility that has been given by SEBI. So first of all, you need to have a mutual fund license to launch a SIF, and they have allowed everything can be shared, which is fund manager can be shared. If you have a mutual fund license, fund manager, the same fund manager can manage long short or SIF. If the operation team, the dealer team, the research, analysis, everything can be shared, which is you are one house, you are one mutual fund house, you have a license, you take this eligibility criteria, you take permission, and you launch a SIF accordingly. So it is a shared resource. The only caveat out here is, because this is what we did also, and a few other of my colleagues from the industry who are doing. So what we believe is the longs fund manager may or may not, and generally I'm saying may not have the capability, talent to just become a long short fund manager overnight. It is a little different space. It is a risk management space. SIF is a risk management space. SIF is a space where drawdowns are supposed to be managed. SIF is not supposed to be like benchmarked. I don't know if you are aware about, there's a web series in USA, and very long running web series. Recently, I saw some of the episodes. I was not hooked onto it. It is called Billions, right? So I think I was in the second or third season when I was seeing, and the series is on a hedge fund manager, and I started liking it because a lot of conversation is related to our markets. And there was one conversation when the promoter of the hedge fund manager is talking to the fund manager and is scolding the fund manager of a hedge fund, saying that we are absolute return managers. We manage our portfolio in an absolute manner. We are not benchmarked. Anybody who's benchmarked is hooked, is anchored. But in long short, you're supposed to manage it in the absolute manner, which is, so in long short, there's one problem, and this problem will lie with people like Ritu. The problem is this, that if somebody calls themselves long short, equity long short, within equity long short, there can be various ways of managing. So Ritu will have to always know what is the way of managing, because SEBI has given a structure. The structure is common to everyone, but within the product, there can be different ways of managing risk, different ways of covering risk, and automatically, depending upon the risk they take, the returns will be made, right? So I will tell you basically what I'm trying to tell you, right? What I mean. So let me just tell you over this slide. In what SEBI has allowed is, they have allowed us 7 schemes that we can launch. Currently 7 schemes only. 2 are in debt, 2 are hybrid, 3 are equity. So let me take an example of the product I'm going to launch, or right, and the products which have already been launched. So you are aware, till now, only 2-3 products have been launched. Only 2-3 products, right? I think 3-4 products now, and we are the 4th AMC who is going to launch. So the 3 AMCs have already launched. I am going to be the 4th AMC to launch my scheme. Now, let's say one of the AMC three products have been launched in hybrid category till now. Now in hybrid category, or or let's say in equity long short, there are two kinds of, actually basically on a macro side, two kinds of ways of managing fund. One is called directional or momentum. Second is called absolute. So absolute return funds are funds like, for example, in the mutual fund category, you have a fund called arbitrage fund. That is like a absolute return, because once you give money to the arbitrage fund, they go long, they go short. At the beginning of the cycle or settlement cycle, when they deployed the money, you know approximately what is the gross yield, post expenses, what can be the net yield, right? So we are all aware arbitrage fund give 5, 6, 7% return depending upon what is the spread in the market. Currently, if I'm not mistaken, it is ranging between 5 and 6. So this is absolute return, which is market can go up and down. My portfolio is long and short, exactly hedged. By the end of the next settlement, if I'm holding, the risk of movement is not there. So I know what my projected returns are. Now in the market, the three products which have been launched till now are in the absolute return plus category, which is if arbitrage is giving 5-6%, maybe they will give 6-7%. So they will not take high risk. But in the directional strategy, what the fund manager tends to do, they will be always risk averse, right? But they will try and catch momentums in the market depending upon the perceived risk. And we at least like the ITI house is a long short fund manager for last almost 8 years now. So in the later slides, I'll take you through. So what directional long short does is it has the capability of giving high returns, like Nifty kind of returns, but at the same time keeping volatility and beta low. So by hedging, by using shorts and so on, which I'll cover later, right? So currently, to tell you, there's 7 products allowed right now, and the major difference between and I'm covering the point because Ritu talked about something how the funds are placed and what are the benefits. I'll tell you one major benefit which is there. When SEBI made this regulation, it gave permission to launch SIF within the mutual fund platform. Now, what natural outcome of that is that your mutual funds are are and I'm only taking the example of equity mutual funds. In equity mutual fund, you are taxed only when you redeem or you switch your money. Otherwise, you are not taxed. You compound your money over long term. In PMS, what happens at every transaction level, the investor has to pay tax on profits. They have to pay advanced taxes. They have to pay taxes on dividends and so on. There can be TDS on your dividends, and you have to every quarter the capital gains you make, you have to pay tax on that. AIF, depending on category 1, 2, 3, the taxes are same, but it is a transaction level whether investor pays or the fund house pays. We all know what mutual fund benefit is. In mutual fund, the benefit is this, that long-term capital gain is 12.5% plus surcharge, if any, and short-term is 20 plus. So I am naturally going by long-term. So in long-term, the taxation 12.5% plus surcharge. So the thing is this, that, in the market with SIF regulation coming in, some of the features are same like AIF and better than PMS. So there is a thought in the market, conversation, debate in the market that SIF can be disruptor or challenger to the existing setup of AIF and PMS, especially with the point that now you can invest as low as 10 lakh rupee as against 50 lakh or 1 crore in AIF or in PMS. With the benefit that these products have been given flexibility of going short up to 25% in the market. So what a mutual fund can't do, what a PMS can't do is this, that if they feel that market is overheated, market is overvalued, or even if they feel that in any cycle there can be stocks which are overheated, right? For example, we have seen 2-3 years back, capital market stocks, sorry, capital expenditure stocks doing, sorry, the capital goods stocks being overheated. Sometimes we saw banking or some stocks in banking being overheated. Recently, I think post-COVID, we saw that there was a run-up in healthcare and pharma and IT, and then there was corrections and so on. So, it is not necessary that only market has to be overrated. It is possible that, some regulation changes, some fundamental changes can affect a stock. For example, in the paint industry, the largest paint company was challenged, or there was a question in the market when the competition, two large competition, JSW and Birla groups, said that they are going to enter into the paint industry. So the largest stock, Asian Paint, uh, might was affected, and people said either it will correct or at least PE derating will happen. Right? In COVID, when India was restricted, so stocks like Indigo or stocks in the banking side were or NBFCs which were in the microfinance were impacted because of collection and movement. So time to time these opportunity come up. Mutual funds cannot short them, right? So, but in SIF we have been given a power of up to 25%. We can hedge the portfolio or short a stock or indices if we want to. So this only exists in AIF long short. It doesn't exist anywhere else. So, from where I started, let me touch base something. In USA, this hedge fund market is about $4-5 trillion. Long short within that is $1.5-2 trillion. So it is a very large market. So what we think is, the point I'm making from the angle is that why SIF will do well, right? One, it will be a disruptor, challenger to AIF PMS. SIF will even challenge schemes like BAF, Equity Saver, to some extent, I'm just saying multi-asset. It may be challenger to ETFs and passive funds, which are large cap oriented, right? And there will be some money that can move from hybrids to and debt, long-term debt products to this category. And over my presentation, I'll tell you why and how that can happen, right? So basically, I'm saying it is not only equity to equity, it is also that some of the debt and hybrid money will move towards SIF category. These are early days. Everything will go through ups and downs, but in the beginning, I can just tell you, in AIF, many people might have been not sure, 1 crore minimum, who will do it, taxation and all that. Today, it is a successful category. About 10 to 13 lakh crore exist in the AIF category, including commitments, right? That much. So why can't that kind of a jump or increment happen in SIF? And consider that next 10, 12 years, some 15 to 20 trillion dollar of savings pool is going to happen in India. So SIF is a new space, but will make a mark over period of time. And my guess is this is not going to be 1 lakh, 2 lakh crore, because if mutual fund industry is going to grow from 75 lakh crore to not less than 500 lakh crore next 10 years, SIF is going to be very large within that also, right? And especially with the tax break and the governance of mutual funds and so on, which overlooks on SIF, it is going to be very good space to be in. So let me go to the product and cover a little more points out there. So no, Diviniti Equity Long Short is the name of the product we're launching. Now let me clarify something. Our mutual fund name is ITI Mutual Fund. Like, there are now, as I talk to you, 51 licenses are there now in the market. So what will happen is you will have to remember new names for every SIF that is going to get launched. Now, I am taking the word Divinity. Divinity word is separate from ITI. Now you are seeing two branding on my slide. Divinity SIF offered by ITI Mutual Fund. The question is Divinity a separate subsidiary? Is it a separate vertical? No, it is not. It is same as a part of mutual fund. What SEBI said is this, that SIF may carry higher risk because of the flexibility of using unhedged position. So you can go up to 25% unhedged or naked short, as they say. So they said we are not sure, but if there's risk which may arise in future due to misunderstanding of people due to misplacement of products. The mutual fund and SIF should be separate. It should be ring fenced so that one do not affect the other. So Divinity is only a brand separately. It is not a separate subsidiary. So it is only a brand, product brand, just like, for example, if you go to Titan, I'm talking watch company, they have a brand called Titan, they have a brand called Xylus, they have a brand called Nebula, they have a they have and within that they will have with Titan will have brand like Regalia or Raga and so on, and they have other brands also. If you are aware about Rolex watch is, as the price has gone up, it is super luxury. Then they have another company or rather another brand called Tudor, Tudor, which is lower placed than Rolex, but apparently placed separately. So a lot of people, and in Maruti, if you see there's Maruti and there's Nexa, a lot of people say, look, I want to brand it separately, owner and company will be the same. So here, every mutual fund will be same. Owner and AMC will be same, only branding is separate. So what we did is we chose our branding at Divinity. And to tell you, this is not out of the blue. There's a lot of thoughts put behind the word Divinity. So the Divinity word comes out of two words. One is divine, second is Niti. But Niti is very easy to explain. Throughout our life in the Indian culture, we have heard things like Chanakya Niti. And recently you would have heard a word called Niti Ayog, which so it is about governance, it is about ethics, it is about planning for the future. That is what the word Niti is. Divine words come from higher purpose. It is about integrity. It is about wisdom. So we mixed both the words divine plus Niti as divinity. The only difference we did is very cutely is this. In the end, the spellings we changed. One spelling we changed, which is Diviniti in the end. So it is, again, you can even say it is Divinity with ITI in the end, but actually it is synthesis of two words, divine plus Niti. Right? And that is how the word divinity came. So I'm repeating it so that you remember, in the end, ITI hai to ITI ka hai. That is what I meant, right? So this is how we coined the word divinity. So when I launch a scheme, Divinity will be name of the fund, just like the Divinity Equity Long Short Fund, Divinity Equity Hybrid Fund, Divinity Equity Hybrid Long Short Fund. That is how it will be. All services to your partners will be same, which is, if you invest out here, you will get same mailback services from CAMS and KFIN. The register RTS service will be same. You mailback services will be same. Capital gain statements, when you want, it will be same. You will have a choice whether you want mutual fund statements, you want SIF statement, you want both the statement. If your investor wants to mailback services, ITI small cap will be there, ITI and Divinity equity will be there. Everything projection will be same, just like in ECAS, equity mutual fund, everything comes. Even mailback services in ECAS also, only Divinity word will be there, ITI word will not be there, but all services that you will get will be same. It is because this is another scheme from a mutual fund house. Only difference is that branding is supposed to be different. Every fund house who launches SIF can go brand it for 5 years. In the 6th year, ITI mutual fund word will be removed from branding. So we will have to be separate. आज बच्चा 5 साल के लिए बाप के साथ चलेगा, उसके बाद सिर्फ अपना नाम करेगा. So Divinity SIF will be there for 5 years. After 5 years, no offered by ITI or sponsored by ITI will not be there. It is only a 5-year branding exercise. After that, you will stand alone. So, I'll go into the fund we are launching. Very frankly, to tell you, it is long shot. Somebody may say, words अच्छे हैं, समझ आ रहा है, but it is not an easy place to manage. In the world, if you remove 2 or 3 names like Peter Lynch or Warren Buffett, most of the fund managers, marquee fund managers, most of them come from the long short side. Most of them. The hedge fund managers are mostly in the long short space out there. So it is not easy. What I can assure you is ITI or Divinity is offering you the best talent in the industry. My CIO, his name is Mr. Rajesh Patia. He's been a hedge fund manager. He's been a long short fund manager for almost 18, 19 years. 30-year experience, 18, 90 years in the long short space. So, for him, it is a very exciting moment because he thinks that the time when people think about retirement, he has to, he is excited that he's getting something to do at the starting of the industry. What we did in mutual fund 30 years, 25 years back, today, at the time when next 5, 7 years I would be retiring, I'm getting a point where I have to work hard, learn, upgrade myself, my skills through these long short funds. So talent, no problem. We had to recruit more people. So we have recruited fund manager to help Rajesh ji to manage this fund. But talent is already there. So whatever I'm covering on the slides is actually what we have done, not backtesting. Right? We have to use the word backtesting because that is how we manage. But they are actually what we have done. So what the slide you are seeing, this is more to tell you how long short funds behave. Long short funds, the fund manager has to follow a rule, and from personally, I call it a rule, a Cinderella syndrome. Basically, remember when we were young, we used to hear stories of Cinderella and how Cinderella was her stepmother and stepsister used to take advantage of her, make do all the household work, and they would enjoy their life. Then there was a ball where the prince of wanted to look for a match. He wanted to get married. They're looking for a match for him, and he threw a ball. He threw a party. So everybody is invited but Cinderella. Then Cinderella, fairy godmother came, and she said, "Okay, I'll turn you into a princess, and you can go and attend the party." There was only one rule. I'm repeating. There was only one rule which she was told to follow, and the rule was come back before midnight, because after the midnight, the magic would fade away. The magic in which जिस जादू से उसको राजकुमारी बनाई थी, वो जादू खत्म हो जाएगा. So she was supposed to come before 12 o'clock. And in the momentum, in the music, in the party which was playing, this is what she forgot. And right at the chime, when the clock started ringing 12 o'clock, she remembered she tried to run. And so why did I tell you this story? I told you the story because the long short fund managers they have to follow only one rule, which is they cannot follow the rule of what Cinderella did. They should not wait till 12 o'clock. Now, 12 o'clock is a risk. Risk is valuation risk. Risk is about momentum. When I told you about the party, let me tell you in 2007, before the Lehman crisis, world was going through a party of liquidity, party of music being played, party of everything being good. Nothing can go wrong. I still remember Chuck Prince, who was the chairman, CEO of Citibank, Citibank CEO, saying that there is a party going on, this party, and this party is of liquidity, and everything is looking good. But when this party stops, that is liquidity stops, world is not going to be the same space. And that is what exactly happened. Once the party stopped, liquidity went out, subprime hit, and everything went for a toss. This is what the fund manager for long short is not supposed to do. They are supposed to look after risk first. It is the dharma of the fund manager. The first principle is drawdown and risk averse. So I always tell everyone that the long short fund managers will be late to the party and early to leave. They are not supposed. They may end up, but they are not supposed to give you highest returns, right? Because in thoughts, in our mind, we have cognitive bias. We always think we will enter lowest, exit highest. Enter lowest, exit highest. It never happens. In the long short fund manager, there's one quality that fund manager should have: fundamental understanding, technical knowledge, experience. Everything is precursor. But one thing which is more required is about risk aversion. And this is what I can assure you, that our fund managers have been managing it. I'm not saying will manage it. We have been managing it. CIO is there for 20 years, 18 years, Mr. Raj Bhatia. We already have a long short fund in AF category, which we are managing for last 7.5, 8 years. And what I'm showing you on the slide is this. I'm showing you what happened in the market in the recent past. From January to March quarter 2023, markets touched up. That was the bottom of that time. Then market started going up. It went up to about 26,300 Nifty level in September of last year, September 24. Then for next 5 months, Nifty fell, and Nifty fell from 26,000. It went as down by 14-15%, right? And then maybe recovered here and there. But today, even when I'm talking to you, we are not 26,000 still there. We are still 3-4% lower than that. But you know what happened? How did we manage our long short fund? What we did is around last year, around June, July of last year, 2024, my fund manager said, look, market is looking overheated. We are on records in our quarterly commentary. We even put it down that it's looking overheated and we would like to reduce our beta. And so we started reducing our beta. You know what a long short fund manager first does? They cut their positions. They have equity, they'll cut their positions. Next, they will hedge their portfolio. They don't go and short it just like that. Well, people think short, long, ye kar denge, wo kar denge. It is not like that. It is a very, very process driven action which is taken. So last year, when the markets went up, we participated. Nifty went up 42%, we went up 45%. Right? But remember, we came in late and we started trimming early. Nifty is point to point. But in the first 2-3 months, we might be late to the party. We will not take very large positions or high risk till we are not sure. And we started trimming our positions 2-3-4 months before the fall of October. And when the fall happened, we were 100% hedged. 100% hedged. Right? I am not even saying short. Short to हमने किया ही नहीं था उस time. Market fell 14-15%, we fell 3%. So in the total movement, markets were up 22%, we were up 40%. So that is what this slide says. It is asymmetric. ये secular नहीं रहेगा. We are supposed to manage money keeping drawdowns की downside protection करना है. श्योरिटी कोई नहीं दे सकता, कहीं नहीं होती है श्योरिटी, राइट? लेकिन उसके फितरत में होनी पड़ेगी, उसकी हैबिट में होनी पड़ेगी. फंड मैनेजर्स have to carry it in them, in the DNA, that my work is to take care of downside, and that is how long shorts in the world are managed. What I just told you, same thing I'm showing you. For this is one point I showed you. 7 years, 7.5 years, this is what we have done. In 7 years, 7.5 years, 4 major crises which has happened, include COVID, include last year falls, include RBI interest rate hikes and so on. Every fall. So this is not only once. It is not fluke. Somebody will say, एक बार कर दिया तो क्या होगा, दूसरी बार तो होगा नहीं. Last 4 years, this is how we have managed. So, and why? Because all the time, remember what I'm going to tell you. Fund manager of long short fund should be absolute. अगर वो benchmark को देखेगा, benchmark बढ़ रहा है, market बढ़ रहा है, it is possible. I will be hedged. Put your hand to your heart and tell me, last 3 years, are you comfortable with the geopolitical risk that is happening in the market? Right? When 3.5 years back, when Russia walked into Ukraine, everybody said it is war of 1 week, 1 month. Nobody said beyond that. It is 3 years plus. We have seen more and more war happening. We have seen 4-day Operation Sindoor. We have seen what happened in the Middle East around Israel. We are almost every day on the brink of something here and there happening or not happening. And if physical wars are not enough, we are having economic wars here, right? And of the core, now leading them is USA. The person who should be most calm is disrupting everything. In that scenario, shouldn't you think about managing risk? Right. So it is not only 3 years, it is much, much longer. So this is what has happened. In India, since long short funds have not been talked about, that is why risk is underappreciated. We have this returns that we are given about 14% plus returns, including after this fall. Maybe it is 15% now, right? So 100 rupees is now about 270 rupees or so. That is our value of the fund in last 7 years. About 15%, approximately, I'm saying 15% compounding after this fall. So, but at what? At a beta of 0.3. I'm repeating, at 30% risk, we are given returns equal to all like Nifty returns. That is what we are given. And that is what our dharma is. So we may not be consistent to Nifty, The Nifty is going up, we are going up. But when the outperformance comes, it will be both. We assure you that on volatility, on downside, and that protection, all that we will cover, right? So there are rules. I'm leaving few of the slides because simple rule is this: take care of your money. Don't and if you ever forget, remember rule number one. 100 can go to 200. If there's a 50% fall, 100 will become 50. But to go back to 100, you need a 100% jump. And it will not be always possible because beta stocks, when they go up, especially in a liquidity driven scenario, you don't get back the piece back. You have to be very careful. This fund is about risk management. So it is about fundamental investing. This is not only about momentum. So momentum is literally not a part, will be very, very low part of this long short funds. There can be scenarios where market does nothing. If market does nothing, post expenses, your product might do nothing. So this product can do better in those kind of range bound market. Because why? Because we can partly take care of shorting it, and we can become like debt fund or arbitrage fund. We can just generate 5-6% of nothing else. That is what we can do. I'm saying extreme environment, right? So this will take care of. And so what that happens, if the market goes down, it can, and if it does nothing, it can impact your compounding through long shorts, especially in scenario where if the market is in the longer zone of your range bound market, long shorts will tend to do well. So there is to summarize, there's a problem in the world which is coming to India also. And the problem is, the sweet problem is this, that interest rates are going down. Interest rate will go down further depending upon two factors. As inflation goes down, India is moving towards becoming a developed market, Viksit Bharat, we talk about. So all this will relate to situation where cost goes down. You would have heard Nitin Gadkari saying that in India, the logistic cost, transportation, logistic, movement cost used to be 14-15% raw material. Now it is 8-9%. We are in line with the world now. So what all this will do is more scales coming, more improvement in growth will lead to inflation going down. A good managed country will see lower inflation, lower interest rate. So if today, only 1 week back, my brother called me. He lives in Calcutta. He told me, look, I have put money on FD. It is giving me 6% return. This is FD with a PSU bank. My first thought was, at 6%, he is in 30% category of tax. He will be left with 4%, 3%, 3% or 3.5% inflation. He will be left with hardly 1% real return. Right. So, and on the other side, if somebody says, I will do equity only, so with all the volatility, geopolitical risk, and some risk that equity carry itself, can there be a product which can take care of both participation but at low risk? And this is where the long short funds come in. Long short funds were made, took birth to mitigate downside impact, to try and control the correction side and participate in markets in the upside. Upside, they may be late to the party, they may leave early, but upside participation will be there. And that is right. So fundamentally, this is what long shorts are supposed to do. The fund manager need to have it in their nature. It cannot just be कि मैं long short fund manager. अच्छा आपने you are IM, you are CA, you become a long short fund manager. They have to learn a lot of things. I can assure you all the talent is available with us. So now to come to the product we are launching, the product name is Diviniti Equity Long Short Fund, right? So within that, what SEBI mandates is this: 80 to 100% should be invested in equity. But within that, they have given two different things which do not exist in mutual fund. One, SIF can hedge up to 100%. If you're looking at my slide, the last line, we can hedge 100%. Mutual fund is allowed up to 50% hedging, but fund manager don't hedge because they are all long. Only in balance advantage, majorly. This partly I've seen equity saver also. This they're trying to hedging, but not 100%. They'll do 10-15% here and there, 20% maybe sometimes, but I don't see much. Here we can do up to 100%. So if I'm 80% invested, I can hedge 80%. And then addition to that, I can be 25% short. I can short a stock I don't own, I can short indices. How will a portfolio, normally a long short portfolio look like? You are given me 100 rupees. I will buy stocks with that, some stock. Remaining money will be in overnight traps or tables, right? So let's say, for example, I invest to make things simple. I invest 55 rupees, 45 I keep in my hand. Now, rest, I need to be 80% invested. How 80% will be invested? I will use FNO for that, long or short. The cash portion, which is T-bills, which can be GSEC, I will use it for as a margin money to take my portfolio positions. So debt portion will always be earning you something. And when I'm long or short, like if I'm hedging, it will give me returns equal to my arbitrage fund. So base case is this, that arbitrage funds returns 5-6% can be generated even when I am not fully invested. And the portion I am in equity will generate arbitrage returns, the portion in debt will also generate the overnight returns. So this is how normally mathematically the portfolio will look like. I will have stocks which are called longs. I will, right, and tactical longs can be there in derivatives. I'll have hedges, I will have shorts. So A minus B minus C will be give me net position. To show you this position on a single chart, this is the example I'm putting. And example is out of how we have managed portfolio for last eight years. So normally my portfolio will be 40 to 60% invested, right? This is the normal position, about 40-60% invested. I will use in a bearish environment when we think that, and we have to anticipate that when we think that things are not looking good. Even if we are late, we can hedge fully. So if I'm 55% invested, and why I'm written 55, remember, I had to be 80% for taxation. I need to be 65% invested, but by SEBI rule, I need to be 80% invested. So 55, if I'm invested, I can hedge 55. And tactical shorts are unhedged position, minus 25. So my extreme position, I'm talking extreme position, theoretically can be minus 25. But in a bullish environment, I cannot be 125. I can only go up to 100. So we just put an example that 55 invested, 45 tactical long, 5 in debt because that will be used as margin money. So 5 to 10 will be margin money. So I can, everything else is in between. So risk aversion is key. Drawdowns is key. Singles and every other rule of SEBI which applies to mutual fund applies here. No stock can be more than 10%. We think that generally when we take stocks in a portfolio up to 2, 3, 4,000 crores, generally, 15, 18 to 25, 30 stocks will be there as long, and maybe 5, 7 can be there. There's when we talk about short, what I want to confirm you is it is not compulsory to be short. Right? We can be zero. We think we don't need to short. We need not invest. But if we are short, we tend to be 1 to 4%. This is our internal risk management that we are keeping. And the portfolio will be biased towards large and mid cap. Why? Because if I want to short or if I want to hedge, there are securities, don't have liquidity. There are only 230 to 40 stocks in FNO. Tomorrow, those numbers can increase. So, and liquidity is not high beyond 120 and 30 stocks. So we will tend, when we take a stock exposure, it will be more large cap and mid cap oriented, keeping in mind the liquidity in futures. But we can always sell Nifty, we can sell mid cap, we can sell banking Nifty and all that. Sorry, banking index, we can do that, but they are imperfect hedges. They are not perfect hedges. Generally, we will be more large cap, mid cap biased. We will buy small cap, but not large proportion. That will be part of my core tactical long, because small caps do not generally have, are not available in FNO, right? 10 lakh minimum investment amount, every day NAV will come, every day you can buy and sell. No restriction on that. This is equity product. I have ample cash with me to fund redemptions. Every day purchase redemption will be there. Exit load is up to 6 months only. But my recommendation is put it for long term. Let this be a core portfolio in your product, in the category. So SIP is available. 5,000 is minimum amount of SIP and multiples of 1 and so on, right? And systematic withdrawal is available, but 10,000 needs to be minimum systematic withdrawal for that per month. So, and in case somebody wants to do minimum purchase, additional purchase, you always will have to be 10 lakh invested, but additional purchases are 25,000 and multiples of 1. Accredited investors can invest. The minimum investment amount for them is 25,000, 10 lakh do not apply to them. So I'm leaving some of these key things out, but to assure you that we have talent, we have experience, we have managed our funds for a long time. We're happy, very happy about this situation. You know, these are just ranges. Presentation is sent to Ritu. I'm sure she can share with you all. But to come back to the product side, and to just summarize and close it, like what this product is going to do, the product is like an insurance in your portfolio. There are people who just ask me, I am a 10-year investor. There are distributors who ask me, there are advisors who ask me, sir, my investor is there for 10 years. Right? Which fund should I give? Should I not give him only small cap? Should I not only give him multi-cap? Yes, you can do, but long short is not necessarily a competition to those kind of positions. Right? For anybody who is rich, you know, why did long short pick up in USA and Western world, in developed market, in Europe and so on, and other market where it has launched? It picked up because when people become rich, they don't want to lose money, but they want some upside participation beyond almost nil real returns. That will give you that returns. But so long shorts came in with that visibility that anybody, if well managed, this product can take care of. So it is a tactical position in your portfolio and core to your portfolio. Both positions can be taken, right? So time horizon is perpetual, if you ask me. And as India is becoming richer, today $4 trillion economy plus we are 10 trillion, 30 trillion will become. More wealth will generated. Everything just so why has AF picked up? Why PM has picked up? Because they were unique positioning. Those products always talked about how to manage risk also. Whether they did or not, you can always debate. But I'm saying that they did. Their objective was very unique and novel, and their novelty factor out there. Similarly, SIF are being placed. So today, you know, we are still trying to pick up SIF. Only 1 or 2 launches happened. A very initial phase of the industry. But I am confident that, you know, next 5 years, this category and going onward, this category is going to do very well. So to give you take care of some questions that you put. One position of the product is this, that, you know, this AIF and PMS, some of the money and lot of the money will move out here. So this is not what I am saying. At least 5, 7, 10 AIF big players are taking mutual fund license. 1 or 2 have already gone and applied, and 1 has got the approval. They want to launch SIF so that they can move AIF money there. Just take an example. If AIF earns 15%, they have to pay 30 to 40% tax. And expense ratio I'm keeping separate. So they are left with 10, 11%. If mutual fund SIF earns 12%, they will be left with 11%. Just see lesser risk, same return post-tax. That is what we can manage. And if we give same return, if AF gives 15%, SIF gives 15%, the post-tax return will have a differential of 3 to 4%. 1/3 tax there, 13, 14, 15% tax there. So there will differential out there. And that is what investors will look at. That is what advisors are looking at. And few of the AIF who applied for license are applying because they think that SIF will pick up from where AIF has reached. What I'll do, I'll stop here so that, you know, we can, if required, we can take questions. And if anything I left, I'll answer there. There is going to be tracking error. There's no point even. Look, there's Nifty is my base benchmark, but there's no point of any SIF being benchmarked, which you asked me. So they're absolute returns. So we will be in the whole cycle, you will see them doing well. Benchmark is there because SEBI or regulator has put a benchmark. We have to keep some milestone, but it doesn't. But if somebody doesn't want tracking error, they should go, well, they should then look at only passive funds like Nifty passive fund. But even there, there's tracking error, no, though not much. Here, at least upside potential is there, which do not have, which will not be there. Upside potential at lower risk is the main is here in long short funds, which do not exist in other funds.
So yeah, I think mostly because, as you said, that a short is not very popular in India, and through AIF only we have seen, few short positions in that particular product. So my first question would be, JP, uh, if you are taking a short position in this product, that would be a stock specific or the index level specific?
So two answers, and good you put a question. I was hoping you would put it right. First of all, let me tell you, when we buy a stock, we buy it on fundamental growth aspects, keeping valuations in mind, right? When we short a product, we had double responsibility. One, when we short it after doing fundamental analysis, I talked about Asian Paint, ABB, Siemens, Indigo, right? There has to be a reason. It cannot be just a dart throwing. Secondly, we have to be very careful about almost an impossible thing, but a timing. So even if you're late, no problem. And when we short, we keep targets in mind. Just to give you example, we think stock will go down 15%, for example, right? If we enter, we get 7-8%, we get out. It's like a sortie. It is not point to point. It is more a kind of a tactical call. That is why it is called. So dual responsibility, fundamental analysis and timing. Complete process oriented. In the last 8 years, 7 years management, maybe on a best scale, single day short positions, we have not even utilized 25%, while we could utilize 100% in AF. Not even utilize up to 18-20%. That is the maximum that we have gone. You can from that angle. So it is not a rampant use. Secondly, you talked about stock or index. Both can be used, but stock will have to be fundamental. इस रीजन के लिए स्टॉक में शॉर्ट कर रहा हूं. Index can be used as a hedge, but imperfect hedge. We think banking, something that doesn't look good, we may not go for 4 banking stock. We may just short banking index.
So in the extreme position, JP, whether it's in an extreme bull run or the bear market, is there any capping, like, what kind of a short position you can take it in the bear market? And how do you manage even in the extreme bull market? This is strategy.
You will find my answer very amusing, because and this is by experience I'm telling. All Rajesh Bhatia managing 18 years, experience is this, that the short, when the markets are bad, already corrected, it tends to act like contra. Then should you go short, question comes up. You tend to go short for structural reasons. Right? Maybe I'll give you example. When we were short on Vodafone, and you can understand very frankly why we were short. Hindsight, we have proved right, but we were short at that one time, right? But when we think markets are down, then you need to look at the portfolio instead of shorting. You have to look at tactical long or buying stock so that they can make money for me later. That is how we look at these shorts. In types of market, the short actually plays out on index or stocks when the market looks overvalued. And stock can be overvalued even in bad market, but I'm saying when they're overvalued. So that is how we look at the market. So whenever we are not confident on the market, the first step we take is cut our stock positions, our tactical calls, not go short right now on the market. We can use hedge, temporary hedge, like what we do in BAF also. But first step is to reduce what portfolio beta and portfolio you are invested in, instead of saying that I'll go short. So short is more stock oriented, bottom up stock oriented, but for the indices I just talked about. And 25% is allowed, but it won't. In the last 8 years we are not utilized so much at all. We were like, because it carry some risk, so we are very, very careful with that. And by the way, options have been used only once. It is always future that we are used.
Whenever on the mutual fund side, when we talk about the product and all, we always talk about the long term, India's long term story, that how you can create a wealth and all, right? Now, when we are talking on the SIF, it's more about the wealth preservation, because we are talking about the long short story and how in the the bear market or in the volatile market you can protect your wealth, or even you can make some kind of a returns from that. So, where India at this juncture, and what is the correct investors for this particular product? Because making this product available for 10 lakh doesn't mean that this product is for all kind of a retail investors. And having that 1 crore, and also, the people who are having 1 crore, they will not come in this 10 lakh. I mean, they will not would have not waited ki, the 10 lakh product will be launched and then only I'll invest. So what kind of a set of profile this particular product is?
Sure. Let me answer first in terms of phase of India and where we are growing. Last 5, 7 years, 10 years, what we have seen more family offices coming. We have seen, those kind of ultra HNI setups happening. And most of that money, investments have moved towards long short funds or towards risk, where risk management can be done. Maybe they were segregated portfolios, but that is how they have grown. Now, at the same time, when we have grown in the last, I think 2018 to 2025, as I talked to you, our economy has more than doubled. We were like $2 trillion, now we have $4 trillion. So the saving capacity of India has gone up. Even if I take 20% as ballpark saving rate, so at $2 trillion, we were saving 400 billion, now we are saving 800 billion. So as we go to a 10 trillion, and even if I take 20% savings rate, it will be $2 trillion saving. So most number of people who are becoming relatively richer will come are happening here in this country, and this is what we are seeing in other countries which have also, like especially USA and China. Partly I will say Japan also, because their run was very long, but they got trimmed at about $500 trillion. So in this space that we are seeing, I think this SIF has come to the app space, though it has kept it 10 lakh, more to say let's say MNI and HNI can enter, because they could have made it 50 lakh, 25 lakh also. But what I think is, people who are using AIF with multiple crores will utilize SIF also. But they will not stop short shy because 10 lakh is given.
Okay.
So, and one of the main reason is that advisors, right? They were utilizing AIF or PMS earlier. They know tax. Everybody is aware about tax break in SIF. So they are already looking at this space. So what will happen is, as more people get on the bandwagon of SIF, today as I talk to you, we take the weekly figures out from SEBI, from AMC. As of last Friday, about 2,000 people, 2,040 people have gone impaneled, validated, paid the fees to AMFI to sell SIF. So Ritu, I can tell you 2.5 months back, when I was launching, giving the scheme to offer document to SEBI, I delayed by 3-4 weeks. Reason being, there were only 55 people in India. The first list 55 people. But I said 55 people agar hai, to who will sell the product? Right?
Exactly.
So I think apparently in the last 3 months or so, maybe 4 months, at ITI level, we have arranged some 13, 14, 15 maybe online digital trainings, and 1,100 people have attended that. Now number is 2,000 plus partners. You may have partners who have done SIF, will invest through you. They may not be in that 2,000 list. So that as the number grows, I think the SIF talking points, SIF points will pick up as more launches happen, more AMCs will put salespeople, product people, branding behind this. So I think what it will do is, this will eat into some of the space of mutual fund, like hybrid had talked about, like passives. This will also be challenger to PMS and AIF. So that money, irrespective of quantum, will move. Right? So it is, and every investor who is in debt fund, you can now look at allocating some money, because you will have 2-3 kind of investors, funds. One will actual returns, which are like arbitrage. You can look at that, and partly we will launch both. But today we are going to be directional, because this is what we have been managing for some time.
Right.
So from that angle also investors will come in. Today, some of the language I use may look Greek and Latin for few people, because I have also picked up last 7 8 months. I did not have to learn all these things 2 years back. We knew they're long shots, but what, right? But now this is going to get offered. I'm telling you, since myself, Kadambari, in touch with the largest distributors of India, everybody, including you. So I remember I came to your office to talk to you, and maybe out of the hat I said, I'll talk about SIS. I have been to SEBI 4 times doing meetings on this. There will be changes over a period of time, but everybody is waiting next 2 3 years. Kaisa hoga? My hope is this, that even the examination 13 should get trimmed down. Trimmed down means there is no need for common derivatives for on the forex side. Okay, debt equity I can understand. So when I came to mutual fund industry, when I gave the first exam of mutual fund industry 5A, the requirement was 60% pass mark, 25% negative marking. Same thing is starting here, right? So as more people come in, I think this will be revisited. So there will be more people talking about this. Today, 2,000, 2,500 people plus partners are there. But this, as number grows, people will be attracted. So I think 10 lakhs will not be a hindrance for 10 crore check also. And I'm prepared to be surprised, because it even the space for AF are created. So similarly, SI will be created. So, and in the end, what I can assure you is 25% is a decent unhedged position. So if tomorrow 50% allowed, my hope is it should come in as a separate scheme. It should not be 25 going to 50, because you have placed 25 already. We should not go and increase the aggression out there. So it should be like 50% separately, and that will happen one day. So as the AUM grows and as the demand grows over a period of time, just the we when I came to the mutual fund industry, we were just selling equity or debt. Then one day they said, first 200 stocks are large cap, no rules, just right. So I sold a fund called Top 200. Then one day mid cap came, then small cap came. No, same way you will see SIF also evolving. So I think the space will evolve, and somebody asked me, do I think the minimum investment amount will come down to as low as 1 lakh or 5 lakh? I think with India becoming prosperous, there's no need, because 10 lakh will look like 5 lakh 7 8 years later from one angle. So let it be 10 lakh only. Let there be distinguishing factor. And my only hope is that tax breaks and all this remain for a long term, because otherwise disruption happens in terms of investors' mind. But treat this as a portfolio insurance. Treat this not comparing to only small cap, multi cap, so on. Right? There are people. I think there's resistance in mind. Exam dena hai, yaar umar ho gayi hai, itne saal baad kyun bol rahe ho, and so on. And there are people who are excited. Rather, I find younger people like you and Kadambari more excited than me, right? In terms of your exam dena hai. So you were more prepared, I remember, right? So that way I'm seeing at my distributor level, this is more IFA level. They're asking their sons and daughters to give the exam. So what they did 25 years back, they are not ready to do now. So new generation is going to take over, and they will not be on the routine side. Our routine will be left aside. So I think things will evolve. Only thing today, what I say is keep your mind. Every team member should keep a mind open. Do not resist कि यार कैसे बेचेंगे, किसको बेचेंगे. There's no need to go and sell 10 lakhs. 1 crore मांगो, 2 crore मांगो. If 1 crore मांगते हो, PMS 50 lakh मांगते हो ना, तो वही मांगो जाके. There's no need कि मैं 10 lakh ही करना है. And tomorrow when I have more schemes, you can place it accordingly. And ultimately, what I have learned is, as people become richer, and the people you are getting in will become richer in next 5 or 7 years, right? So both sides. So I know I was talking to a young distributor who's just starting, 25 years old, 3 4 years of work experience in a capital market, says I want to become a distributor. He's going to set up a wealth management firm. He told me, what should I look at in future? I told him, next 10 15 years, can you build a business based on all the young people who are around 25 30 years old and will be so rich because they're going to rise in hierarchy in jobs in business, and let them be your investors and work on everything else, right? And that is what is going to happen in India. So you will have more and more people who are getting richer, and this will be in the portfolio. This will, I won't say replace, this will challenge debt, but this will replace hybrids. passives, AIF, PMS. That is the scope it has. Mutual fund, small cap, multi cap will remain. And then there will be a time, Ritu, sometimes, market kharab kar raha hai, this fund does well, people will then jump in onto this.
Hmm.
And then market बहुत अच्छा कर रहा है, वो लोग बोलेंगे अरे SIF take नहीं कर रहा है, people go there, right?
Yes.
But that is why what I just want to do, I took little more time in introducing the the space. Reason being that a well-positioned, informed positioning will help us to do better as collaborators of this product.
So, yes, thank you, JP. I think you explained very well, since starting, like what is SIF, comparison of SIF with the different multiple products, how SIF we can position among the investors, and what all the categories would be the, as a seen as an alternative to this. So, thank you for explaining very well. Now, lastly, I would quickly, summarize this the entire thing in a few, pointers, just, to help you. And quickly, why Divinity SIF? So, as JP very clearly mentioned is in his presentation, like because SIF itself is a very new space for all of us, but the product which ITI is launching, they are running the same strategy under AIF since 7 years, 7+ years. So that is the reason we have picked up this product, and the product has a well acceptance on the AIF side. They have a well acceptance in the market and the well counters, and has shown a very strong performance. So probably that is one of the reason we at a Nirmal Bank have has picked up this particular product, and this is, I think, this is first of the long short strategy. We have seen two other, on a hybrid side, we have seen that product have come up, but this is first equity long short strategy SIF which has coming up. So the NFO window will open from 10th of November to 24th of November. Yes, and experienced leadership. As he said, the fund manager is having around more than 19+ years kind of a experience. So these all kind of pointers makes this product strong. And at a Nirmal Bang level, or at a product and research person, we also find that the fund is not having like a back tested, it's kind of a real returns which they have generated. They have seen a different market cycles. Over a different market cycles, they have generated a good and strong returns, and a strong a strategy. Probably I won't use the word return, I would say a strategy, because the market cycle keeps changing. And probably I'm just hoping mutual funds, nobody understand the risk adjusted return. Hopefully SIF introduced in the market, and probably people will, and the MFDs strongly will start understanding what is the importance of the risk adjusted returns. So as JP showed, like beta is only 0.30%, so which is only a 30% wallet, 30% of the beta. And then you can see the similar kind of a returns which actually the index has delivered. So so these overall, these were the pointers. So here we have covered the product and why we at a Nirmal Bank we have selected this particular product. So would request each and everyone kindly go through the presentation. We will share the presentation and all the literature of this particular product. Kindly go through and provide your support to us, as well as the ITI. And just a one request here, as JP said that NISM 13 exam is compulsory to sell this particular product. So don't wait that when the NISM will tweak the exam and then soften and all, but at least try and give an attempt to clear this exam, and then only you can sell this particular product. So that's my own humble request to all of you. Kindly appear for exam and give that particular exam to sell SIF and participate in the SIF market. So, JP, any closing remark? Just quickly, I think one person is asking, How does the asymmetric return profile perform in flat or volatile market compared to pre pure equity fund?
In a flat market, we can be like a arbitrage fund where we will invest in arbitrage and debt, and that will generate maybe 5-6%. I'm just thinking theoretically,
Hmm.
though we think there is opportunity always on stock specific in every market.
Hmm.
So look at Setu, I think we have sent you all the details in terms of last 7 years.
Correct,
So,
correct.
so,
Yes.
so, there's no, so I think if required, I can go through it and update you later, or you can go through it. But generally, I'm saying theoretically, whenever, if we are completely hedged, we earn equal to arbitrage and debt return. That is what we'll do. So thank you for the opportunity, Ritu. I think I don't know if you could feel it, but I'm quite excited with this new category coming in,
Yes.
been part of this from day one. So very frankly, at ITI, somebody may say you could have waited. I don't think there was any point waiting. We wanted to win race from the day one. I think this is going to be catalyzer only. So it is possible. Sometimes distributor, some of the settled distributor think what can unsettle them.
Hmm.
Things like this will unsettle because when they don't sometimes understand that things, people are growing rich and next generation is also catching up. The ideas, views, thought process change, and you have to be prepared for that. And at least for SIF, which is like a shadow of AIF with some benefit, rather some good benefits, you cannot ignore it. So I hope I go right in the coming times. But to some extent, you can just take, and your team can just go by my experience and some, maybe some bit of more positive that from the word divinity, as I talk about some wisdom which comes from past experience, which I think I'm visualizing the future, that can this be a 5 lakh crore AUM in the next 5 years? And my answer seems yes, it can be. So do not miss this because incrementally, it is possible that this space will be the fastest moving space in the next coming time. So everything will move, right? Because in mutual fund, there are SIF to support. That is insurance to mutual fund. But this can be one of the fastest moving incremental space in the AF, PMS and mutual fund space. So don't be out of it at least. Be prepared and then you can, and for you the benefit is whether mutual fund or SIF, you can do everything.
So, with this optimism, we are just closing today's call. Thank you, everyone. Thank you for participating. And thank you, JP. Thank you for your time.
My pleasure. Thank you so much for having me.
Thank you.